Good afternoon, gentlemen. And we are here again to present our results for the first 6 months. Am I audible?
Yes.
Okay. Thank you very much. Welcome to this session. As usual, we'll take you briefly through the presentation that we have made for you. And at the end of the presentation session, we will take the questions from you or any clarifications that you may have. Yeah. So this is what you have here for the course of our 1 hour presentation here. You have a brief introduction to the company, then our board of directors, shareholding pattern, the management team, some updates on the fiscal and economic data for Oman, our own dividend history, why Alumania, our products. Then we come to our actual financials and some slides on the very unique attributes of our business model, especially the non-performing loan review, prognosis, and question and answer session. And I hope you will will participate and enjoy what we are presenting. Thank you. Go ahead. So I won't read out the entire slide. All of you are very much aware about Alumania. Yes, as you know that we were founded in 1997. And thereafter, we had launched a public issue with 60% contribution coming from the founder members, including Bank Muscat. And 40% of the 3 million capital was put through an IPO, which was oversubscribed by 43 times. That's a record still, and where currently our net worth is about 70 million. So that's been a long journey from 1997 to this is our esteemed board of directors. You can see here Sheikh Khalid Al Wahibi, who has been our chairman since inception of the company, almost since the inception. And we have here Sheikh Khalid, our deputy chairman, who currently also chairs the Bank Muscat. We have Sheikh Zaki, who is the chairman of our audit committee. We have Sheikh Ibrahim. We have Sheikh Tariq. We also have Mr. Shikhar Dharamsi. And we have 2 members representing the pension funds, Mr. Salim Nabil, Mr. Nabil Ahmed Zehran Al-Mehruki, and Mr. Imad Sultan, representing the Ministry of MOD. And we have the director in place of Mr. K.K. Abdul Razak, Sheikh Awad Mustail, who is a very young and a very talented director that we have now on our board. So we'll go to the next slide here. Gentlemen, you can see, you know about this. 68% of our holding comes from institutional investors. Among the investors, apart from the pension funds, we also have some family businesses, family offices. We have some commercial banks, etc. And the 32% is in the hands of the individuals and smaller groups. That comprises our holding pattern. And by and large, most of our shareholders have been with us since the very inception of the company. Okay, this is, we are in a way very, that we have a very long-serving management team. And if you see here, the team that we have has more than a combined experience of more than probably 100 years or plus. Everybody's been here with us. If you can just rotate the camera, and then they can just say hi to themselves and introduce themselves. How can you rotate this camera, Manish?
Hello, everyone. I'm Lata Ramakrishnan, and I'm General Manager, Risk Management, and I've been working in Alumania since last 27 years, almost from inception. Nice meeting you all.
Mr.
Hi, how are you? I'm Chandrasekhar, handling finance. I'm the Chief Manager of Finance and the Head of Compliance. I'm here with the company for the last almost 25 years. We'll be completing 25 years by 15th August. Nice talking to you all. Thank you.
Mr. Go ahead, Mahmood. So Mahmood Dajjali.
Hello everybody. Mahfoud Al-Zijjali, marketing manager. I've been in this company now 24 years.
Alhamdulillah.
Thank you.
Mr. Ram Kumar.
I am Ram Kumar. I am with Alomani since 2000 onwards, 24 years complete.
Yeah, myself, Viju Varghese, Head of Corporate Credit. I'm with the company since 20 years now.
Hello, I'm Prema Shivakumar. I'm heading a lifestyle department, working since last 22 years.
All right, and then we have finally Mr. Manish Bhaskar, who is the head of our IT. Okay, there you can now way out. I already given your interruption.
Yes, thank you, sir. I'm here, Manish, working for last 20 years and all, and providing all our services to all the departments.
Thank you very much. Now, Mr. Okay, gentlemen, this was a brief putting face to this slide, what you see here. Let's move on to the next slide. Okay, this is, I think we're all very familiar. This is our product segmentation. We have a full portfolio of corporate finance products, starting from working capital, bill discounting, debt factoring. And on the liability side, we also accept deposits from companies or various tenors. Then we have a full portfolio of retail financing products, which actually caters to, which is under the brand name of Lifeline, which is basically caters to the individuals as well as small and medium corporates, and for buying the vehicles, etc. Then we have a third product, which is a hire purchase finance loan for acquisition of brown and white goods. So basically, I think this covers the entire spectrum of our products. Go to the next slide, Manish. This is, gentlemen, why Alomania is relevant and makes sense to the market that we are in. You would see here that we have been we have been promoted in 1997. We started our operations. So that makes it almost now 29 years. How many years?
27.
27 years of continuous operations. 27 years of continuous payment of the dividend, cash dividend. We have more than 100,000 customers with us, and we have a consistent track record. We have the lowest NPAs, right? Our capital structure is robust. Our capital adequacy is among one of the highest. Come inside. Is one of the capital adequacy is one of the highest. We are rated well by the regulators, and I think, and we are also in terms of liquidity. I think we have a sound liquidity in place. This is briefly our dividend history since inception. So for the first accounting year of the company, we had paid a 12% dividend. And thereafter, I think we have been consistently paying dividends right up to 2023, including the COVID years. Total dividend paid since inception is 491.87%. We are indeed very proud of this achievement, and we hope that we'll be able to maintain the uninterrupted dividend that the company has been paying since inception. I will not take much of your time. We'll leave you a lot of time for the question and answer session. This briefly is the current economic performance for the Oman economy 2024. I think we have been seeing that, the average growth here, developing economies from 4% to slight slowdown in 23. And all in all, I think Oman's GDP amounted to about 104 billion Omani riyals, is up by 0.8% as compared to 10.3 billion. And our credit rating has improved, and we hope that the next rating, I think, will be, we understand that the ratings will go up further. The next slide. So the outlook remains very favorable for Oman. I think the offtake of credit has also substantially improved. Government's emphasis on diversifying away from the oil is beginning to show some promise and beginning to show some results. We are very confident that both the employment in the retail, in the private as well as government sector will grow. This is expected to boost the demand for both capital as well as consumer goods, and will also boost the demand for the credit. We also see now there has been several projects that have been awarded for infrastructure. This augurs well for the overall growth of the economy. This is the rating, gentlemen, that you can see. We did go through a difficult time post 2016, and now we are back on being B1 and stable, positive, and we expect these ratings to improve substantially going forward. Now you can see oil prices have remained steady over 2023 and 2024. Oil production has by and large remained steady. Oil revenue has by and large also remained steady at 2.8 billion for 2023 and 24. I think so that augurs well. Go ahead, next. Yes, here if you can see from 2014, where we had a debt to GDP of 4.3%, and it went to a peak in 2020 of 67%. That is the time we saw a gradual reduction in the country's debt rating. And that, I think, has been set right now. And we are at a healthy 36.5%. We expect some more payments possibly to come in. And this will expected to go back to in the range of about 25 to 30% in the next year. So I think that augurs well, and that also reflects in the improved ratings for the country. So this is a very pragmatic and fiscal policy that the government of Oman has adopted. Next slide. Now, here we come to our review. I know if you see, we're looking the numbers at the last 5 years here, 20 to 23. Of course, the 19 and 20 were the COVID years and difficult, challenging years they were. But Alhamdulillah, we were in a position to stabilize, maintain our growth, consolidate what we are doing, and also produce a reasonable return for our stakeholders, our shareholders. In all these years, if you see, our debt equity has been very conservative, which gives us a very strong position to borrow. Our net worth has been steadily growing, and excepting for the COVID year where the dividend was lower, I think we are back on the track, 11, 12, 12.25, and last year it was 13.25. We also have the unique distinction of being permitted to pay non-convertible bonds as dividend. So far, we are the only company which has been given permission by the regulators. We are grateful for that. That speaks volumes for the confidence that the regulators have, both in our numbers as well as in our liquidity position. And this will help the shareholders. It is a kind of a deferred cash dividend. And I think company has sufficient liquidity, sufficient capital, very robust debt equity ratio. So we don't see any problems, and we'll continue to work on this policy of rewarding the shareholders through the non-convertible bonds route. Now, this is a comparison with the what you see here is finance income 23 and 24. We have seen a growth. The interest income has been steady by and large at the same level. However, the interest expense is marginally up. As we all know, the increase in interest cost and provision for expected credit losses are low because currently we have 500% provision, and some of the provision has gone into interest suspense that was required as per the guidance issued on a particular exposure to all the financial institutions, including the banks. So that amount had to be moved from provisions into interest suspense, as a result of which we have seen about 5.6% growth for this first 6 years. We will maintain this growth momentum in the next 2 quarters as we see. And based on that, I think I don't want to speculate, but based on that, hopefully we should be able to maintain or improve the share dividend to the shareholders. No substantial change here. We are continuing to maintain a strong liquidity position. The liquidity position is continues to provide stability, provide low cost funding to the company. We have never had a situation where we had to either slow down the rate of lending or stop for some time. We don't have any such issues. Company continues to attract significant banking facilities from within Oman as well as from outside. The interest has been high. Our total assets are about 209 million. And I think we're sitting pretty right now, and hopefully let's see what the next 6 months bring. This is the total liability side that you would see. Bank borrowing has been steady. And you can see here the unsecured non-convertible bonds of about 3 million, on which interest has been paid, and they will be redeemed as and when they mature. Not much change here. Very steady, very constant here, and retained earnings continue to swell at about 17 million. Total equity about 65.8 million. And that gives us almost a book value of more than 2 riyals per share, about 200 paisa share per share. These are some of the statistics here that we present to you. Stage 1, Stage 2, and Stage 3 are by and large very, very steady here. We have not moved much away. Earning per share has marginally improved. Yield rate is slightly down because we saw some spike in the rates in the first and second quarter. Average interest rates the company has been borrowing is just under 5% at all tenors. Absolute NPLs, 3.8 million. And I mean, these numbers speak for themselves. 502% coverage is what we are currently holding. Next slide. Now we will give you some comparison. These are the numbers from the published results. This exactly copied from the balance sheet as published by our peers. And you can see here the Stage 1, Stage 2, and Stage 3 assets. Right? And you can also see the availability of the provision. NPL cover is 80, 83, 75, 76. So as compared to what we have, net NPLs, we are the only company which are negative in net NPLs. Very interesting point here is that look at the average cost of funds. Is about almost 4.9 for Alomania, 7% for and 6.68, and almost hovering around 7% for the peers. So clearly, we have about 150 basis points, 150 to 200 basis points lower in the cost that we borrow. And currently, our total borrowing is about 135, 140 million. If you translate that into the saving, you're almost talking about 2.5 to 2.8 million as a lower cost. And that's simply because of the quality of the book that we present. We are not operating into the subprime, right? We continue to be prime and prime plus, and that is being acknowledged and appreciated by our lenders, where they feel confident to lend to us at a very, very competitive pricing. Now, what we see, we are cautiously optimistic, gentlemen. We have not taken a very, very aggressive approach. Yes, we are seeing some very sound fundamentals coming out. Economy seems to be on the upswing. But since we operate only on the prime and prime plus markets, we continue to be cautious. Our aim and objective is to make sure that we pay a reasonable dividend, pay all our stakeholders a reasonable a reward for their efforts. And that is our very significant. Sustainability is a very key parameter, a very key giveaway that we operate on. That is one of the KPI that we are very, very concerned. We don't want to have a very large performance and a sudden fall. We don't want the instability. We don't want, especially for our shareholders, we continue to perform and they can continue to believe that, yes, Alomania will deliver now and in the long term. Now, we almost are done with it. And may I request any questions that are there, kindly introduce yourself and your company and kindly stick to the presentation and the financials made. And let's not get into any kind of speculation. Thank you. Yes. Go ahead.
Am I audible?
Yes, please.
Hi, good afternoon. This is Bishan Bhala from Vision Capital. Thank you for this call and for the presentation. Congratulations on a decent set of numbers. A couple of sort of observations / queries. You mentioned about company having an extremely liquid balance sheet and cost of funding being significantly lower than the sector. Congratulations for that, and we witnessed that for a long period of time. But now, when I look at spreads for the sector and your peers, the spreads are also on the lower side for Alomania. So you have this competitive funding, and you have this advantage of cost. But when it comes to spreads, I've noticed that the peers have a slightly better spread than Alomania. Now, part of it boils down to the fact, like you mentioned, about lending only to prime customers. I understand that, and that point is well noted, and we see it across your risk ratios. But when we look at growth, the Oman banking sector, which pretty much lends to prime sectors as much as the leasing sector does, that's grown at almost 4.5% over the last 12 months. Whereas with regards to Alomania, I've seen a degrowth over the last 12 months. So if you could just give your comments on having a great cost of funding, competitive advantage, but probably not translating that into spreads, at least momentarily. If you could give your comments on that, please.
Yeah. You see, the net margin that we have, if I look at H1 results and from the figures that have been published, our net margin is about 2.8% as compared to 0.2% for one peer. Peer 2 is 2.25. Peer 3, the largest one, is 2.96. And the peer 4 is 3.92. So there's not a very significant difference in this because the cost of borrowing itself is 2% higher. Now, if I were to go subprime, let's say I were to go subprime, my interest cost won't hold. So there is an assumption sometimes we tend to make that if you were to lend, if I were to target, let's say an IRR for between 15 and 20%, right? I can do that for 3 to 6 months. And within 6 months, my cost of borrowing will move from 4.9 to 7%. So that advantage is lost. So what happens is really, if you follow that practice or that strategy, you continuously have to go subprime and more subprime and more subprime, right? That is what we have also seen happening with the some of the institutions. We have a lot of experience if you gather from the worldwide how financial institutions operate. So that is a vicious cycle that we don't want to get into. The moment you get into subprime, there is no more exit strategy, right? And honestly, whatever you've been doing on the growth, etc., does growth make sense if there are no rewards for the shareholders? If I understand correctly, 2023, we paid the highest dividend after Bank Muscat. So if I have a balance sheet of 300 million, 400 million, a 20% growth, but I'm giving you 3, 4, 5% dividend, would anybody be happy with that? So that is a very self-defeating strategy. It looks nice, You see, what you're really saying, if I understand correctly, saying, I want to eat my cake and have it too. Right? Yes, we want the low cost, we want the prime plus, we want the security, we want the liquidity, but we want 20% growth. These are actually kind of a contradiction. We are a boutique finance company, and we're not going to shun away from our business model, right? What we call our strategy is operating within the box, not outside the box. So we define what our parameters are, what kind of credit we want, and we will operate within those boundaries. Now, we will not shun away if there is a business that we value is available, because as you know, we have enough resources. So why do we don't write? We write whatever we consider as the top quality. For example, let's say you make one mistake, or you have to provide 100% for one deal, you probably lose the margin on 50 to 60 of your financing deals. Let's say a typical car of 10,000, one bad car you finance or one bad customer you finance, 10,000 if you write off, that your profit on the next 50 deals is gone. So this is a kind of business that we are. We don't want to build a Ponzi scheme, kind of a Ponzi business model. We would like our business model to be very robust, very transparent, and should stand to the test of time.
Right. Thank you for those observations. I appreciate that detailed answer. But, having said that, now I'm to understand that you operate in the prime segment, which is completely understandable. But if I look at the banking sector, because clearly you probably benchmark yourself against banks, right? And you mentioned how your dividend is second to Bank Muscat. Kudos to that. And we've seen that historically, you've been one of the highest dividend payers purely because of your liquidity position and your coverage ratio. But alone, dividend isolation is not the complete picture, right? Now I understand on the past call you mentioned that stock market price is not in your control, and I completely understand and respect that. I wouldn't assume that to be in your control. But if I look at another important metric, which is what we talk to every single bank or financial institution, is the return on equity. That is something that is in control of the management, right? They're responsible for that ROE expansion to shareholders. So when I look at ROE for Alomania versus the banks, or even versus the leasing sector, whichever way you'd like to look at it, I find that also probably on the lower side. So if you could just give your comments on that. The dividend is excellent, but if I look at ROE overall, that has not meaningfully grown over the past few years. So if you could just give your comments on that particular perspective, because stock price, I completely get, we'll not go into that. That's not in your control, but the ROE probably would be in the management control. So if you could just give, and this is considering that the company pays out the maximum permissible limit every single year versus some of the other peers in the sector.
Now, what happens, suppose, for example, we were to restate our income statement in line with what is there, what are the policies that are being followed by the other peers. So it should say that we need to compare apple with apple, and therefore we say that we will live with the current level of provisioning of the RPR, which is an average, if you leave out Alemania, it is an average of about 65 to 70%, right? Now, which means that if I follow this strategy, then in the year or two, my ROI will go up. But as soon as I lower the provisioning, the regulations will not permit me to pay the dividend that I'm currently paying. Because it says that unless your net provisions or the NPA cover is negative, net growth in your NPLs is negative, you cannot distribute 80 or 100% of the dividend that we pay. So if you have a situation, you have merely got higher profits because the regulation or your ECL model allows you to do a lower provisioning because it is subjective, it is judgmental, but you cannot pay the dividend. But what you really done is that you paid a much higher tax liability and you have understated your provisions. You have and also paid a lower dividend to the shareholders. So whom does that benefit? Right? Now, assuming that what you talked about the share prices and all that, which, but why, if you look at the Alemania share price, I believe, we don't look at it on a daily basis, and it's currently among the peers the highest. We still command the highest share price. So what I'm saying to you is that it's not impossible to increase the ROI in a short period of time. Now, once you increase the ROI, get into subprime, then what happens is you keep getting more and more into subprime so that you continue to maintain your ROI. But whom does it help? Does it help anybody? As I said, we are waiting if there is a growth opportunity, if there are any, ways to grow, both either a virgin growth or through any other mechanism, we are open to it. So that's not something that, we primarily protect and make sure that we are having a sustainable business model.
All right, noted.
I know that. Yeah.
So having said that, okay, I take your point now. Of course, on the share price, with due respect, I understand Alemania is the highest share price, but that's not Oman Refreshment trades at R1 and made losses over the last 2 quarters. So I'm sure you take that point as well. So yes, of course, I understand the company's done extremely well for investors over the years. We've seen it ourselves, but I was just talking about what the future holds. Now, with respect to cost to income ratio, if I may just ask, of course, I understand net profit. I'm aware of that. Now, if you could just talk about cost to income, that's that pretty much stands out as the highest in the sector and a noticeably higher amount in the sector. If you could just give your comments on cost to income, sort of how does that go down to market average or
we, rather than looking at the cost to income ratio, we look at as the total overheads as a percentage of the income. Right?
That's also among the highest in the sector, sir.
So that is for us currently, if you see, it's about 31.88 as compared to, say, 25% for one peer. And there's one peer who has got 41.58. Then you have another peer, 39.5, 20, and the average is 31.71, and we are 31.88. So we might not be better, but we are not really worse. We are better than 2 companies and marginally higher than 2 companies. So we are somewhere in the middle. We're somewhere in the middle. That is one. And also total overheads here, includes provision.
This includes recoveries. Just your income includes recoveries. So when you tell me the calculation, that includes recoveries. So if I exclude recoveries, that ratio goes much higher. I'm just telling you in terms of the formula we've used.
No, total overheads as a percentage of total income.
Yes.
Look on a total basis.
Yes.
Then we are 65%. Our total overheads, including interest as a percentage of total income, we are 62.5. Then
Yes, sir.
you have other companies at 65%, 88%, 68, 65, and 70. Here we are lower than the average. So what is really happening is that, yes, that if you look at it in a selective basis, only as overheads and nothing else, maybe we appear a little higher.
Okay. No, I was just trying in terms of, is there any strategy to bring that number down? Of course, I understand the comparison. I've done that.
Yes, you know,
And I would always
that,
benchmark Alumani as the best in class.
Yeah.
I would probably compare you only with the number one, not the lowest in the sector, like other metrics. So I was just seeing is there any strategy and just more of observation more than anything else, sir.
Yeah, see, we are conscious of the fact, and then as the volumes and the incomes grow, and that will be we expect that it will fall. As you said, there's also the saying that goes, that you've got to attract the right talent, right? So only because if you're not attracting the right talent, then obviously in the end it can probably cost the company more.
Right. No, point well noted. I was just trying to understand if there's some strategy. So, effectively, if I look at provisions this year, next topic, we've seen a drop in cost of risk, which is encouraging to see. So if you could just comment on how net provisions have evolved this year versus, what it was last year. Last year, on average, it was approximately 500,000. Now it's almost 160,000.
What has really happened here is that on one of the corporate clients, the regulator has issued a directive that the interest on that client has to be suspended. So there's been an accounting change as far as we are concerned. It moved from provision into interest suspense.
Okay, noted. Right.
Okay.
So that's where the drop in provision.
That's the reason why there is a drop in, and overall provision requirement was low. If you see, our NPLs are just 3.8 million.
Right. Okay, noted. And overall, just I understand I'm not looking for any future guidance or any sort of forward-looking numbers, but in general, you have a clean liquid balance sheet. You have a lower cost of funding because of that liquidity position. You have a good provision coverage ratio. When does that translate into bottom line growth? Because as much as I take your point in terms of you being a prime lender, I do see an entire sector of banking growing at a much faster pace where we've seen meaningful bottom line expansion. So just trying to understand when does that process happen for Alumani?
Okay, fine. I'll just quickly address that. But tell me, yes, which is the bank that you would like to compare with us to?
I would not, on a call for Alumani, I'll just talk about the banking sector at 4.4%, but you can take your pick, sir, with any bank that you think is relevant.
So what I'm saying is that if you look at the provisioning that has been made, and we know what the regulators say about us, and Alumani has been talked about as an example to the banking sector itself, right? And so what we're saying here is that, yes, we will, continue to grow. We're not going to shun growth, but we're not going to just grow merely for the sake of growing, right? And we're also expecting some growth. For example, tell me, which institution do you think will get permission to give non-convertible bond as dividend?
Within the leasing sector, I completely take your point. That's the reason I'm not even referring to the leasing sector. I'm talking more in terms of.
So what I'm saying, there are some
positives
which emerge from our business model. It's not without low cost of funding, stability, high liquidity. We don't have to go around, borrow at high cost or suspend lending, so on and so forth. So there are certain pluses, and we don't see too much minuses simply because we are paying adequate amount of dividend. Ultimately, see, your concern would be, in Oman, in the GCC markets, the way we are, a lot of share prices are a function of the dividend paid because we are dividend-driven markets, right? And therefore, I think it's the dividend which keeps the markets happy about what we're doing. So I think Mr. Abbas is there, who has been wanting to say something.
Sure, sir. Yeah, I'm done with my queries. Yeah, thank you so much for this presentation and patiently answering my queries, sir. Thank you.
Go ahead.
Good afternoon, Mr. Patel, and good afternoon, the entire team. Thank you very much for the call. Really appreciate the detailed sort of, landscape that you take us through every time. So I kind of appreciate that. Just a quick one. I was looking at your average cost, lending rate that you have. So, you're borrowing at close to 4.5%. You're making a spread of 2.5 to 3%, and you're lending at 7%. And then I'm trying to reflect on the prime market of your borrowers, right? I mean, that's something that we've discussed in many calls, and I completely see that. The number is evident in your NPL ratio, extremely, because that's been a story that's been going on. Do you think the challenge that you face for growth is that you are competing with the banks on the prime market, but you're not able to match the lending rates of banks because banks are lending at 5 to 6% to their borrowers, while you are still, even though you're the best in the leasing sector, but you're playing in a different sort of field where the borrowers are mostly the guys who have access to banks. And that's a challenge for you when it comes to lending and growing your loan book. Is that a challenge? Because you're also 80-20 corporate to retail, right? Unlike the sector, 80% of your lending is towards the corporate sector. Now, these guys who are the prime borrowers, they have access to banks at much cheaper cost of borrowing. So is that the pie of the puzzle that's troubling you, or am I missing something?
There are two things, Abbas. Yes, what you said is, partially correct. It's not only the fact that we are by and large able to compete with the banks. The rates might be marginally a few basis points here and there higher. But where we come in really is two things. One, how effectively and very quickly we're able to lend, because we don't have as cumbersome procedures as some of the institutions have, number one. Two, we're able to very, very quickly deliver. Three, our personalized service is very high. Typically, if you say, for example, if a client has borrowed between 5 to 10 million from a bank, he does not get a very dedicated relationship manager. That probably 5 to 10 million client, if you have, the relationship manager would probably looking at 50 clients. So he might not be in a position to pick up your phone and answer your queries immediately. Whereas with this, what happens, there is a very dedicated people which deal with each client. For us, 5 and 10 million, we value that client as a large client, right? And therefore, we lean in very heavily on the service. And that's what the clients appreciate. They say, okay, maybe we're paying a 0.25% more, that's all, 0.5% more, but the effective service that you get. Secondly, where we face a challenge, not only on the rate, is our lending ratio. For example, our clients are probably same to some of the large premium banks. Now, I'll say, according to the regulations, we can lend maximum of about 10 million, right? So however good the client may be, once we reach a limit of 10 million, there's no further lending that we can do.
Right.
Whereas most of the banks lending a possibility, maybe the minimum lending for them, which is equal to 15% of their capital or net worth, will be in the range of 50 million, 40 million, 100 million plus, and so on. So both in terms of the quantum that we can lend, rate at which we can lend, are two challenges that we face. But we then, more than that, we make it up in the service that we render, the personalized service that we have. And since we have a business model, like you said, our average cost of funding is just under 5%, which gives us a tremendous amount of flexibility, right? Even on the retail now, if you see, for example, right now in the market, people are lending for, let's say, 10 years, 15 years on a second-hand car, right? That you realize is a pretty risky business to do. The car have no value whatsoever, 15 years. There are now people who lend for 10 and 15 years on a second-hand car. We don't do that. We still stick to good premier customers where our rates are a little lower. And the customers also prefer to come here because we say, no, it's a service and maybe very competitive rate.
Right.
See,
okay.
Okay, go ahead.
And then the follow-up to that question is, when we were, we've had these calls quite regularly, and you were looking at obviously a better growth number than 23 when we last spoke. Now, in the first half, I know the year is not over, there's a degrowth. So did something surprise you with regards to the riskiness of the market? Because clearly this is a conscious call. Like you said, it's very easy. Lending is the easiest business in that sense if you don't care about getting the money back. So did something surprise you Because the way we look at it is the economy is going through a 3-year good cycle. You yourself spoke about the different rate increases that have happened. So logically, one would assume that the quality of borrowers has also gone up because the economy has gone up. And when we last spoke to you, when you were looking at 24, and it was not a firm guidance, but it's what you were expecting for the year, the way you always share your prognosis, has something gone different than what you expected for the first half?
You know what happened? What took the whole market by surprise was the persistent increase in the cost. Now, when the cost of borrowings, everybody's expectation was that we will see some decrease happening in, we're all hoping the first quarter, second quarter, the last quarter of last year. And unfortunately, the inflation numbers and the deficit numbers in both in the US and the European markets did not augur well for it, right? And even as of we talk of June, when the Fed met, they only said, yes, we will probably consider a reduction, certainly will not consider a increase. Now, if you look at the bond prices, both have softened because of this. The bond prices went up again after the last Fed meeting, and the US Treasury prices, at what were at a historic high. So that also affected our ability to borrow into US dollars. Now, if you go back just 2 years, we probably had about 100 to 150 million borrowing on our books in US dollars, when of course, the LIBOR was historically low. Now, today, borrowing in dollar does not make any sense because you're looking at, between 5 and 6% or more. So that, I think, was what we expected the rate cuts to happen. And if that would have happened, that would have directly gone both into our income statement, and it would have also allowed us to expand some of the corporate clients that we're looking into. So that's one, I think, issue on where I think the expectations didn't rise up to the reality, right? And you see not only us, I think there's a lot of institutions suffered on account of that. But hopefully, we are now seeing a very definite trend that maybe in the third by September, certainly by December, anything between 25 to 50 basis points cut might be there. And if you have noticed, I'm sure you know, it is also beginning to reflect in the bond prices. Bond prices seems to have softened a bit. Yields are coming down. On the deposit side, also, I think market has softened now. The rates are beginning to fall, right? And let's hope that, things will shape up better. But what we have really done is that, we have cut our, provisioning cost because we are better managed again. We're continuing to maintain 500%. So there has been, though some degrowth, 2-3% in the asset size, but profitability is on the upswing. 5.6% is the growth in profitability that we have without compromising anything. If we go along with this, that should be, it should reflect in what we finally pay out to the shareholders.
Right. So just to reflect on the dividend part, it's a discussion we often have, and I agree with your characterization of the redeemable bond as a deferred cash dividend. But the convertible bond is not. Convertible bond is like a bonus share. So effectively, I do not include that in dividend calculation. It's like me saying instead of 100 shares, you have 200 shares, so the price should halve. So ideally, nothing changes. But yes, the redeemable bond is something that's definitely a deferred cash dividend. And personally, as an analyst, I look at it as a part of the total dividend. Now, I have noticed Alomania has not been able to pay a redeemable bond dividend every year. You did it this year, last year was convertible, and the year before that was again redeemable. Now, is that something that is just based on a conversation with regulators, or there are certain rules that will allow you to play redeemable versus convertible? Because that really changes the overall dividend the company can provide, because clearly that's a fundamental strategy of Alomania to maximize dividends to shareholders and let the stock price reflect based on that. So coming to the redeemable part of the dividend, is that every year you have to renew a conversation, or are there certain guidelines that if you meet those guidelines, like you said, negative NPL, you can pay redeemable bond as dividends, specifically in your case, because you have very comfortable retained earnings and NPL ratio?
See, there is no, defined policy on this. And each year we have to take this conversation to the regulators. But we are pretty confident and we are focused now to look at the non-convertible bond as a premium instrument to as part of the dividend rather than the convertible bonds.
Okay,
So
this is very helpful.
really don't talk about convertible bond at all. We are currently only talking about the non-convertible bond,
Correct.
and that's what we're going to focus on.
Yeah, because I think the convertible bond actually ends up putting pressure on the stock prices later on when the shares come to the people and then they want to sell it and there's no active market for it. So I think redeemable bond is actually a very good way to go. And like you said, you're probably the only company who does that. I don't know anyone else who's done that. I know Bank Muscat did a one-time capital optimization, and we spoke about this on the last call. Have you given more thought to it? I think the way we ended the last call was you said all options are on the table, and if it makes sense for a capital optimization plan, you study it further. Has there been any progress from your side to study a further capital optimization plan, or you don't think this is the right time?
We have not really seen a lot of enthusiasm from our shareholders on that.
Okay.
Because the belief was that it's better to have a sustained regular flow of income rather than trying to capitalize, it's just like, you don't kill the chicken that lays the golden eggs kind of thing. And so we were looking at it, but somehow I don't think it was something that our board, etc. was keen. But if there are opportunities, yes, we will. I mean, we're open to everything.
Sure. And I just want to leave you with the thought. I'm sure you're obviously aware of this. The reason sometimes your dividend number does not match with our dividend number is because although 60% of your shareholders, 70% have been with you since the start of the company. So effectively, when you're looking at the dividend for them, you're looking at the percentage of capital. But for me, who's relatively a newer shareholder, and let's say my clients, and we own a pretty significant chunk of this company, for us, we always scale it to the market price, right? Not to the 100 paisa, because that was not my entry point. So for me, the dividend, I agree with your comment that the dividend in especially in our countries that are dividend hungry, they kind of set the tone for the stock price. So, but I just want to leave you with the thought that we always look at it from a market price point of view, not from 100 paisa, simply because that's not our entry point. It's not. I'm not a shareholder who was there with you from 97. So this is just something I wanted to share with you. My two bits, Sure. And my last question, sir, is, this 500 provisioning coverage, the virtual cycle of provisioning that has given you such tremendous, competitive advantage, and it's no chance. It's a strategy that's, you've done in good years and bad years. Now, I'm just wondering, when you go through a 2-3 year good cycle, right, a bull cycle, where the natural rate of, given your conservative policy of issuing loans, the natural rate of provisioning obviously comes down in a good market. At the same time, the accounts that were classified as bad become good, not all of them. Do you feel the recovery cycle will pick up? Or again, am I missing? Is there more to the discussion? I'm losing some nuance in this, because I always get excited that Alumania is sitting on this 15-16 million real of dividends against actual NPL of 4 million. Maybe some of this money starts coming back to you, in a one short sort of. Yes.
But in lending business is unlike, as you are very well aware, that it's not like, you sell a television, you make an invoice, get the money at the end of the story. In lending business, you are integrated with the client's business over a decade or more, right? And anything can go wrong at any time. I have seen, I've been into this lending business for 40 years now. Everything is hunky-dory. Suddenly a very good client, I don't have to, you just analyze, introspect about what I'm saying. What client was very good 2 years ago, now suddenly might start needing provisions. The bluest of blue chip client who was there 2 years ago, who the entire lending, all the institutions would have probably scrambled to their offices to lend. Today, start working with some kind of reschedule and restructuring and stuff like that. So this lending business is like that. You can never be sure. That's why historically, if you look at UK regulations, they actually allowed you to have such secret reserves. They allowed you to have what you call as cyclical variations in the profitability. So they would balance it out and say, so that we make it even for all. Now, of course, the accounting standards have changed. But when and what can go wrong is very, very, very unpredictable. right? You lend for 10 years. Just imagine, is it possible to see what's going to happen in 10 years? Typically, your term loan is 8 to 10 years now. Minimum, even on the retail lending, the lowest that we lend is 5 years. Just imagine what can go wrong or right in 5 years. So if you are not provided, then you can come to grief.
Right.
So that is the reason why something comes, a cycle improves, we collect something and we realize that something else has gone, might need a, some
Right.
approach. So that
Right.
was constantly happening. The fact that our shareholders are not impacted by the cyclical changes in the credit worthiness of the borrowers is the important thing.
Right.
I don't have to come back to the market and say, oh, we had an X client, we had lent 10 million, is bad. So please, now for next 2 years, I can't pay you dividend.
Right. Right.
Also, and it constantly, every time it happens, you just look at the last 5 years, how many large accounts have been rescheduled by the financial institutions in Oman. I'm sure you're aware about it. There's several of them.
Yes.
So that is the reason. I think, Abbas, there's somebody else also, Mr. Kothari or somebody? Oh, he's left. Okay. So we have another 2-3 minutes.
No, I have. You've answered all my questions. In the most informative and very well-rounded perspective as always that you share. It's always a pleasure talking to you. Thank you very much. I appreciate the candor and the experience that you bring to the table. Thank you. All the very best.
Thank you, Abbas. Thank you, everybody. And I think another 2 minutes will close this session. All right.